On today's episode, we are going to take a look at Adobe. They just reported earnings, and this company is up 4% after earnings. And that's some good news, especially after today. It's been such a red day for the overall market. So I'm happy to get some good news on today's episode. So let's get started. All right, so let's start off with the stock price performance for Adobe. At the end of the day, this company was down 4%, for almost 5%, sitting at $20 down. After hours, this company is up about $16, about 4%. It's still a bit lower than yesterday's close, but at least this company is up. In the past 6 months, taking a look at February 20th, which is when this market pretty much started to tank, this company is up right now about 2.3%. I want to say probably closer to 5% if we take a look at the values after hours. So that's actually pretty crazy, right? For Adobe, a company that I feel it could be very beneficial due to the working from home style, to be only up 7%. I just find it pretty weird, right? That I would have expected this to be up a lot more. But we can see though, the market cap for Adobe is $187 billion. So this is a big boy, right? Most of those other working from home companies that we've seen go up in price, they're those with those really small market caps that people feel more likely are going to continue to grow, to be heavy growers. But still, at 187 billion market cap and still growing at the values that I've seen the revenue growth, this is actually going to show a pretty stable company. And before we go any further, guys, don't forget to hit the subscribe button, the thumbs up, and the bell. It helps the small channel out so much, and I truly appreciate all the support. Finally, if you guys ever want to get in contact with me, I'm very active on YouTube. I'm very active on Twitter. All the information should be below. And I also have a Discord channel, which is free to anybody that feels to join. Obviously, I have some rules there, but if you guys want to come ask questions, just feel free. Remember, I am not a professional and nothing I give is advice. All right, so let's start off with just the earnings results for the company. This was for quarter two. Quarter two non-GAAP earnings per share were $2.45, which ended up beating by 13 cents. GAAP earnings per share were $2.27, which actually beat by 16 cents. This company had a revenue of $3.13 billion, which is up 14% compared to the same time last year. So another thing we can see, right, this is a little different from some of the other cloud stocks and some of the other software stocks that we've been taking a look at. One, this is a very, like I mentioned, a very big boy sitting at almost close to $150 billion market cap. The other thing, this is actually a company that both in non-GAAP and GAAP earnings per share is providing a strong earnings results. And another thing, this is not as heavy grower as the other companies, but it's still considered a nice grower, right? 14% year to year it's not a small task to actually accomplish. That's actually pretty good. So it's still, we can see there's still growth happening in this. All right, so now that we took a look at the quick overview of this company's earnings results, I want to take a step back and look at historical value. Let's start off with revenue growth. And let's see how revenue is growing in the past year. For the full year of 2019, Adobe grew about 23%. In 2018, revenue grew another 23%. In 2017, the company grew 24% compared to its prior year. And right, we can see this company has been growing at a steady 20% pace. And that's actually pretty impressive, right? Even for a big company to be growing 20%, I am actually pretty impressed. Unfortunately, this quarter, we did see only a 14% increase in revenue, right? Let me zoom in a little bit for you guys. We only saw 14%. So yeah, we can see this company is on average is growing about 23%. But this past quarter, even with the working from home statuses, it only went up 14%, even though the average of the past 3 years were close to mid-20s. So that to me is actually something I'm not that excited about, right? I really would have been excited if I would have seen something above their average, but to actually see a revenue growth below what their average has been in the past 3 years, it's kind of like, okay, I can now see why this company is only up a certain percentage right now compared to the overall market. Next, let's take a look at this company's margin. So remember, this is this is a software stock. And actually, one thing I want to take a look at in a bit is what this company actually does. I should have done that earlier. So after we take a look at their margins, I'm going to discuss what their products do so we can understand who some of their competitors are and what they have that other companies don't have. So this company is a software company, as we're going to see. So you normally expect software companies to have very high gross margins. This company in 2019 had a gross margin of close to 85%, and that seems to be the average for the past 7-8 years. So that to me tells me this company is pretty stable right now. We're not going to see much of an increase in gross margins anytime soon. What I am happy, if we take a look at this chart, all these greens are the profit margins, and profit margins year by year seems to have a nice uptrend going up. So even though there might be some years where it tips a little bit down, the overall trend is still up. In 2019, profit margins for this company were 26.4%, and that's actually pretty impressive. To me, I think that's actually pretty impressive, and we're still seeing continuing growth there. So this company does maintain a nice amount of its money of sales. And the next thing I want to take a look at before we take a look at what this company does is the operating cash flow margins. And this is how much money this company keeps from its everyday activities in a percentage wise. So in 2019, this company's revenue was about $11.17 billion. The money the cash flow it kept in its everyday net cash flow from operations was $4.42 billion. So that gives an operating cash flow margins of about 39.4%. And one thing I can see, the overall trend we can see continues to go up and up and up, which I think is pretty impressive. That's something you want to take a look at over the term of the business life, and that's pretty good. But at the same time, just the value, being able to keep about 40% of your cash from your revenue, I think it's pretty impressive. This is not something many companies can do, and it just tells you it just shows you that, hey, as this company increases revenue, it's also going to be able to increase the amount of cash it's keeping from that revenue. All right, so now that we took a quick back step at seeing how Adobe's values and how their financial history has looked like, I said again, to me right now, Adobe looks like a very nice company. Even though that revenue growth is not as high as I would have expected, it's definitely not a company right now that's screaming a true buy, but it's a company I wouldn't mind having a position in. If that makes any sense, right? It's not a company I would pay any price for, but if the price was right, it's a company I would definitely jump into. So now let's understand what Adobe does. So Adobe pretty much has a few services. The three main services are Adobe Creative, and now with the cloud market and everything, they have become more of a subscription based as well, and pretty much working with the cloud where you can pretty much work with their software anywhere you're at, where you don't need to have it in your laptop. You can pretty much just use any type of computer to work with their program. So Adobe Creative Cloud, that's pretty much what, if you guys know Adobe, one of their biggest thing is Photoshop. They also have Premiere Pro, they have Adobe XD, Illustrator, and all of these, just like the name, are for creative purpose, to be able to bring the creative side of you: graphics design, photo design, video design, illustration design, 3D, and all other types of creative methods. So this is actually this is a software that is really used for anything, right? Any YouTube right now, most YouTubers are using it to create their thumbnails, social platforms, if you are social design, if you're just trying to create a logo or create some form of creativity, Adobe Creative is one of those major top players in this game. The second platform that Adobe has is Adobe Experience Cloud, and this is more of a CRM. If you guys don't know what CRM, it's Customers Relations Management. So what CRMs, they're more for enterprise type companies, and it depends for all small business, medium business, large businesses. And what it pretty much does is it collects information for you based on your customers, how they click, what type of click rate they have. So it pretty much collects all the stats you need to make sure when you launch a product, you know what color to use, what type of text to use, how your customers react to certain things. So I actually did not know that Adobe worked in this space, and they're also in these type of enterprise type businesses. They mentioned they have a lot of customers: Verizon, Under Armour, Mercedes-Benz, Charles Schwab, HP, Home Depot, GE Healthcare. So these are some big names that are working with their program. One of the biggest competitors for this would be Salesforce, which is all ticker CRM. But yes, that would be one of the biggest competitors here. And for Adobe Creative, one of the biggest competitors who I would think about would be not Adobe. This is Adobe Autodesk. Autodesk has a lot of software creativities, even though most of them are for really hard tech 3D modeling type base. They do have a nice amount of creativity software as well. So that to me would probably be my closest competitor for this and for the other. The final big one, they have a lot of other smaller business, but the final big business they have is Adobe PDF, and with that comes stuff like being Adobe Sign, right? So Adobe Sign is pretty much like DocuSign, where you're able to sign files pretty easily without have electronically signed files. And again, it's supposed to be safe for work business to use. So again, that big competitor would be DocuSign. So now that we understand what Adobe does, we took a look at their historical value. Next, I want to take a look at their earnings results and just a little more highlights of what happened during their earnings. So first, let's just start off for the guidance. This company for Q3, Adobe sees a total revenue of about $3.15 billion in revenue. This is actually lower than what is expected by analysts. Analysts say that this company in Q3 is expected to make closer to $3.3 billion. And this is sometimes you normally see, right? Sometimes companies tend to downplay what they're really gonna make. And I think this is what's happening right here. I do think analysts might be a little bit closer compared to what Adobe is giving us. Next, let's just take a quick look at their revenue. Their revenue is broken down into different parts, but one of the major parts of their revenue is digital media revenue, and that's up 18% compared to the same time last year. But the one I really want to talk about is digital media ARR, and ARR is annual recurring revenue. So these are their subscription-based revenues. Digital media ARR was 9.17 billion, and so that's for the full year. It's expected to do 9.17 billion of subscription-based revenue. Remember, I said that 2019 the total revenue for this company was what did I say? I think it was close to 11 billion. So a huge portion of this company's revenue comes from a subscription-based type platform, and I think that's actually pretty impressive, because just like you and I, right, when we sign up for Netflix, when we sign up for Disney Plus, when the enterprise signs up for some form of subscription, it's usually very hard for that company, for them to come out. And it's not hard because the company makes it hard to do. It's just like, hey, it's just a subscription, a monthly subscription cost. It's not really affecting too much, so let's just keep it on. And I think that's actually that's where we see a lot of these software companies heading to. And a lot of these companies are the ones that are leading the market right now. All right, so now the final thing we want to, actually not the final thing, well, I'm getting way ahead of myself. Right now, we're going to take a look at the report this company gave to us. And after this report, we're going to take a quick look at this company's balance sheet. And first, I just highlighted some highlights that I thought were important to know, right? There's no point for me. I went through the whole form, the whole thing, and I only want to share what I think is important. The first thing is Adobe this quarter is still doing purchase buyback. They bought about $2.6 million of 2.6 million shares during the quarter, and I think that's actually pretty impressive. There's not many companies out right now that are continuing their buyback program, so that kind of shows how they feel comfortable with the amount of cash they have, right? Because the first thing companies stop to do is when things start to go bad, they stop buyback programs. And the reason they do that is so they can have money just in case things go bad. If this company is not doing this, then it means they feel comfortable with the amount of cash they have, that they don't need to stop certain things like this. All right, so next I want to take a look at this company's income statement, and after this we'll take a quick look at the balance sheet. So here in their income statement, there's a few things I wanted to show highlighted. Total, we're going to take a look at revenue right now compared to the same time last year. So Q2 of 2020 compared to Q2 of 2019. Quarter two total revenue, like I mentioned, was $3.1 billion compared to 2019, which was $2.8 billion. So we see a nice increase there of total revenue. And the reason I wanted to show that is even though revenue did increase, the actual cost of revenue only went up by about $10 million. And that's actually pretty impressive. The other thing I want to talk about is their total operating expense. And total operating expense counts like research, development, and sales and marketing. This also went up, but not by much. And to me, these are the ones that I normally expect to go up. Research and development, especially as a software company, you need to make sure your program is up to date. You need to make sure you're fixing all the bugs. You need to make sure it's better than the other program. Sales and marketing, you need to make sure you're getting more customers. And by having a better team, by having a stronger team, you're actually making that happen. So total operating expense only increased by 100 million. Total cost of revenue only increased by 8 million, but total revenue so that's about $100 million increase in expense, but total revenue increased by close to 300 million. So that to me is actually pretty impressive, and I just wanted to show that about the company. All right, so next I want to take a look at this company's balance sheets, and this was actually pretty weird. I'm comparing May 29th of 2020 to November 29th of 2019. So this is actually comparing it to 6 months ago. Normally, you normally see comparing it to just the previous quarter, so it would have been like February or March of 2020. So this is actually a little trippy sometimes. But first, let's just start off from the total current assets. So total current assets two quarters ago was 6.5 billion. This quarter was 6.65, so an increase of 150 million. Not a big change there. Some of the major changes come from cash and cash equivalents and short-term investments. So again, nothing really big there to really be happy about, but this company in short term has about $4.3 billion of quick cash, and hopefully that's enough to pay to deal with the liabilities. Next, let's take a look at just total assets. Total assets for this company right now are $21.6 billion compared to $20.7 billion 2 quarters ago. So that's an increase of about $900 million. We know about 200 million came from total current assets. The other actually came from two things in long-term assets. First, this company does have some deferred income taxes. So this is just some tax assets, and it's about $231 million. Nothing crazy to brag about. The second is two quarters ago, this company did not have to report a certain asset, where now it does, and that increased by 489. So in reality, if we don't count that asset that wasn't counted back then, the total assets hasn't changed by much, and that's okay, right? As long as total liabilities, if we take a look at it, doesn't increase by much. If in theory, what we want to see right now in liabilities is actually a decrease in liabilities, but if liabilities are actually flat, it's actually okay because assets are pretty much flat. But the last thing we want to see is liabilities actually go up. All right, so now let's take a look at liabilities. Let's start off with total current liabilities. Total current liabilities last two quarters ago was 8.2 billion. Right now it's 5.2 billion. So that's a decrease of about $3 billion. And you might be like, Jose, yes, that's great. And it is, but we're gonna see that this company's just moved that current liabilities. It had, and let me tell you what current debt is. Current debt in the current liabilities is debt that needs to be paid off in the next 12 months. What this company actually ended up doing is it had debt. It actually ended up taking out another debt to pay that debt, and that other debt has been moved on. So we can see, let's just jump into long-term liabilities. Long-term liabilities last 2 quarters ago was about 1 billion. This quarter was about 4 billion, so an increase of about $3 billion. So what this company most likely did was it took out a new debt with a longer timeline to pay off this debt and then just bring it back down. So that to me, it's okay, right? I mean, rates right now are pretty low, so I'm pretty sure this company got better rates, and this company right now doesn't have to worry about any long-term, any short-term debt at the moment. Back to total current liabilities, one thing I want to mention, right now, total current liabilities at this quarter were $5.2 billion. $3.3 billion of that total current liabilities is actually deferred revenue. And deferred revenue, if you have not been watching my show, for me, I consider it a fake liability. It's just, for example, it's that subscription base. The best way I explain it is imagine Netflix. Netflix, you pay for a full year subscription. But that full year subscription, right now we're only in, let's say, June. Netflix still owes you 6 months of products, right? Because you paid for the full year, you've only watched 6 months, so you left with 6 months. That other 6 months you have already paid for, but Netflix has yet to provide you the service for it. That revenue there is considered deferred revenue. Eventually, as the months progresses, that revenue will actually go into this company's cash, and it will no longer be counted as a liability. So for me, that's why I consider it a fake liability. Taking a long-term look, total liabilities did increase by about $600 million. But again, this company did have a liability just like assets that did not have before. So if we take that out, this company's liabilities is actually pretty flat compared to this company's total assets. So to me, there were no big changes there. One thing though, this company has enough cash to pretty much pay off its total debt. And that to me tells me this company has a very, very strong balance sheet, especially when this company only has $10 billion in total liabilities. Out of that, $3.3 billion is deferred revenue. So to me, this is not a perfect balance sheet. I wouldn't give it like a B+. I would probably give it like a B or B- if it was a grade. All right, so next let's take a quick look at this company's valuation. Forward PE ratio for 2 years from now, this company has a forward PE ratio of 34. We can see that this company is making profitable earnings and is seeing great revenue. A forward PE ratio of 34 to me might still be a bit tiny high, especially since this company is only growing about 20% for the past years, and this quarter actually only saw about a 15% growth in revenue. This company does have a very strong balance sheet, and it does have really good gross margins of about 85% gross margins and about 25% profit margins. This company's annual reoccurring revenue is actually pretty high as well. So I can see why investors are paying a premium for Adobe. To me, Adobe, right, it's a company I wouldn't mind holding. For sure, definitely it's not a company I would mind holding. But I don't think it's a company I would go out and running to buy anytime soon. Again, if I wanted to diversify my position of my portfolio a bit, Adobe would be one that would make the name and would be close, and maybe one that will open up a small position. But like I said, Adobe right now, I do like their balance sheet. I like their historical value. I just think for right now, it might be a bit tiny overpriced. And right now, I do have plenty of growth stocks where I have to be careful how much I overpay for certain companies. There's certain stocks where I don't mind doing a quick overpay, but then once I start overpaying for too many companies, that starts building some form of worriness in my portfolio. So for me, just based on my current portfolio, I don't think I'm gonna go buy Adobe anytime soon. And if I do, it will most likely be a small position. But at the end of the day, my opinion, right? This is not professional thought. I can understand why people like Adobe and why they're up after hours. So I hope you guys enjoyed today's episode. Like always, make sure to subscribe, make sure to hit the thumbs up. I appreciate all the support. I truly, truly do. So take care, guys. Have a good night and see you next time.